So this is a recap of the objectives as it relates to retirement income planning and retirement planning in general. So when you look at the picture of this mountain and you look at the question, what is the objective? So if you talk to a professional mountain climbing guide, what is the ultimate objective of climbing this mountain? Most people will say to get to the top. That's the first thing that we think of, which is really a lot like the marketing message we hear from Wall Street and financial advisors in general. It's all about the accumulation. Save, 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 save more. It's the accumulation side of the discussion rather than the true answer, which is to get to the top of the mountain, successfully then get back down the mountain. You can't climb to the top of Mount Everest and just take a break forever because you won't make it back. The goal of a skilled mountain climbing guide is to actually complete both sides of the journey. And that's the key. It's one continuous journey. It is not a stop and start. You can't get to the top of the mountain on Everest and ask a helicopter to drop you in a bunch of supplies. It just doesn't work that way. So you have to pack your bags correctly. If you pack your bags on the upside, you can have a successful trip back down. And really, in our case, when we're talking about retirement distribution, you can truly enjoy your retirement. So let's look at things here from the perspective of pre-retirement versus retirement and the rules associated with those two things. Number one, it's important to remember that the rules over here are extremely different than the rules over here. They are 180 degrees different. Let's take a look at an example. So, 180 degree change in the rules. So let's start on the left-hand side. As we're climbing the mountain, we're working our way towards retirement, taking our income, for example. Inflation is a good thing. Inflation helps our retirement accounts grow. It helps the value of our real estate grow. Pretty much any investment we might have grows in part due to the effect of inflation. Dollar cost averaging. Dollar cost averaging is a strategy that suggests that we should buy a particular investment like a 401k, mutual funds, etc. We should buy that investment consistently at the same pace every month or every year so that at the end of a period of accumulation, we may have purchased more average shares. The average price of our shares may have been purchased at a lower price, so we benefit in the long run. So dollar cost averaging. We also hear all the time about average rate of return. Average rate of return, where the stock market over the last 20 years has averaged 10% or 12%, or my portfolio has grown up by 8%. It's always referred to in the average rate of return. Again, going to that idea that the majority of the marketing message from financial advisory community today is about accumulation, which is an average rate of return. Then we have some things like 401k. 401k works really well if you are in a lower tax bracket when you retire. If you retire in a lower tax bracket, 401k could have worked out pretty well for you. If you retire in a higher tax bracket, it may not be as beneficial. Another idea is that in the accumulation phase of our life, we might have mortgage interest. We might be getting a tax offset because of mortgage interest. We might also have company K-1 income, or we might have a business where we get tax-deductible expenses. And finally, the longer we get to go up the mountain, the more time we get to accumulate assets, the better. Longer is better. On the other side, when we talk about coming down the mountain, retirement, inflation is bad. Inflation now is eating away at the value of the purchasing value of our money. So now we need more money drawn out of our retirement accounts to pay for the cost of goods, to pay for our lifestyle. We also have something called sequence risk. We no longer have dollar cost averaging or average rate of return. Now we're worried about what sequence do we get our returns in. Because if we get a sequence that is not favorable, we can have a significant chance of running out of money. Now, instead of average rate of return or dollar cost averaging, now we're dealing with reverse dollar cost averaging. The exact opposite. When the market is down and we're in an accumulation phase, we get to buy more of that investment at a reduced price. When we're taking money out of our account and the value is down, we have to take and sell more of that asset to meet our lifestyle. Next, we have no 401k, and if we're in a higher tax bracket, the money that we put aside in a 401k could be a real burden, could be a really tough thing to deal with. If we plan correctly, we'll have a minimal or low mortgage or no mortgage. So we have no offsets from mortgage interest. If we're retired, we're also not doing business deductions anymore. So we don't have business or K1 or company expenses to write off. And finally, the big one, mortality. Longer living people, as we are today, equals a big risk, and it's actually called, and I'll write it in a different color here, mortality risk. The mortality risk, the risk of living longer and possibly outliving your money. So these are the rule changes associated with accumulation on the left versus retirement on the right. And as we go forward in our conversation, we'll talk about how do we prepare for the right-hand side when we're distributing money from our retirement accounts. That'll be one of the next videos to come.